Every empire that tried to fix the price of gold ended up fighting a war it couldn't win. In the 1960s, that war was fought in secret, in a small room in London by 8 central banks who made a quiet promise to each other. No matter what the market thinks, no matter what inflation does, gold will stay at $35 an ounce. And for almost 7 years, they pulled it off. They called it the London Gold Pool. It wasn't a swimming pool. It was a hidden stockpile of gold in a coordinated operation run in the shadows to hold back a tidal wave of demand. Traders saw a price on their screens. What they didn't see was the cartel behind it, ready to dump tons of metal the moment that price tried to move. And the question is simple: why did the world's most powerful central banks have to form a secret pact just to keep one number from changing? This is the gold dossier, where money, power, and history collide, and nothing is ever as simple as it looks. By the early 1960s, the entire global monetary system sat on one fragile assumption. The US dollar was as good as gold, and gold was always worth $35 an ounce. That was the heart of the Bretton Woods system. After World War II, 44 nations agreed to tie their currencies to the dollar, and the dollar promised to convert into gold on demand for foreign central banks at that fixed price. It was a simple story. The dollar is stable because it's backed by gold, and the rest of the world is stable because it's backed by the dollar. Elegant on paper, dangerous in reality. As Europe and Japan rebuilt, they exported goods and accumulated dollars. Those dollars were not just pieces of paper, they were legal claims on US gold. At the same time, the United States was running growing deficits, spending heavily at home and abroad, financing Cold War commitments, foreign bases, and later a very expensive war in Southeast Asia. More and more dollars were flowing out. The amount of physical gold in U.S. vaults was not. Foreign-held dollars kept piling up. U.S. gold did not magically appear to match them. Soon, foreign governments and central banks were in a strange position. On one side, they held mountains of dollars. On the other, they knew those dollars could be converted into gold at $35 an ounce. The math started to look uncomfortable. There were more claims on U.S. gold than there was gold to satisfy them. If too many countries decided to cash in their dollars for metal, the famous vault at Fort Knox would drain like a bathtub with the plug pulled. Markets noticed first. They always do. By 1960, gold in the free London market traded above the official U.S. price. At one point, the market price briefly pushed past $40 an ounce, while the official promise still said $35. That gap wasn't just a curiosity. It was an arbitrage opportunity written in neon lights. If you were a foreign central bank, you could buy dollars, redeem them for US gold at $35, then turn around and sell that gold in the London market for more. Risk-free profit, as long as the US kept its promise. The more the free market price drifted above $35, the bigger that profit became. The system had developed a leak, and smart players were starting to reach for buckets. For the people who designed Bretton Woods, this wasn't just a market glitch. It was an existential threat. If the world concluded that gold was worth more than $35, the entire story of the dollar's stability would crack. Confidence in the US currency, and by extension in the post-war monetary order, could unravel quickly. So, in November 1961, the men who ran the system met in private and did something extraordinary. They agreed to secretly rig the price of gold. 8 central banks joined the Pact: the United States, the United Kingdom, West Germany, France, Italy, Belgium, the Netherlands, and Switzerland. Together, they formed what became known as the London Gold Pool. Not a public institution, not a treaty debated in parliaments, a behind-the-scenes syndicate operating through the London bullion market, designed to keep the gold price nailed to $35. The idea was simple. London was the center of global physical gold trading. Every morning, a small group of bullion banks conducted the fixing, setting a reference price based on bids and offers. The gold pool decided that if this price tried to rise above $35, they would quietly order their agents to sell gold into the market, flooding supply and pushing the price back down. If the price dipped below $35, they would buy, supporting the floor and refilling their reserves at a discount. The United States committed to provide half the gold used in these interventions. The other 7 members contributed the rest, each taking on a share of the burden. Profits and losses from the operation were shared according to a formula agreed in advance. On paper, it looked like technical cooperation. In practice, it was a central bank cartel with one job: hold the line. The most important part was not the mechanics. It was the secrecy. This wasn't something you campaigned on. You didn't tell the public you were manipulating the gold price to hide pressure on the dollar. Officially, the market was free. Unofficially, it had a guardian. For a while, the system seemed to work. Through the early 1960s, gold stayed remarkably close to $35. When speculative waves hit, the pool stepped in, sold a little metal, and the surface calmed. To an ordinary observer, it looked like stability. To anyone reading the internal reports, it looked like constant firefighting. There was a deeper problem. The forces pushing the price up never went away. U.S. deficits were not shrinking. The Vietnam War was escalating. Domestic spending was rising. More dollars were pouring into the world, and more foreign governments were quietly wondering whether the promise at 35 could really be kept forever. Inside the pool, the numbers told the story. In the early years, there were moments when the group could buy gold back, rebuilding some of what they had sold. But by the mid-1960s, the balance shifted decisively. They were selling more than they were buying. Pressure was building. The stabilization was not a gentle smoothing anymore. It was a defensive operation against a market that increasingly believed gold was undervalued. Not everyone in the Pact was equally committed. Charles de Gaulle in France was one of the most vocal critics of the system. He argued, publicly and bluntly, that the dollar ES privileged position allowed the United States to pay for its deficits with paper, while other nations paid with real goods and real gold. France began converting its surplus dollars into metal, sending ships to New York to collect bullion and bring it back to Paris. That wasn't just an accounting choice, it was a political statement. We trust gold more than your promise. Inside the London gold pool, the mood soured. Why should everyone keep sacrificing their reserves to defend a dollar price they didn't fully trust? Why should European countries bleed gold to cover the consequences of American policy? At the same time, the wider fabric of the fixed exchange rate system was fraying. In 1967, the British pound, already under strain, faced a massive speculative attack. The UK government was forced to devalue sterling by roughly 14%. If the second most important reserve currency could be devalued overnight, how safe was the first? The shock triggered a wave of doubts. Investors and central banks drew the obvious conclusion: if one pillar could fall, another could too. Speculators turned their eyes to gold. Demand surged. The pool had to step in more aggressively, selling larger and larger quantities to keep the price from breaking through 35. France, increasingly dissatisfied, decided it had seen enough. It formally withdrew from the London gold pool and concentrated on building its own gold reserves rather than defending the common price. One of the insiders had left the room. That decision sent a loud message. When one of the founding members walks away from a secret pact, you can safely assume the pact is not as solid as it looks. Confidence, both inside and outside the system, began to crack. By early 1968, the quiet war between central banks and the market turned into a full-scale panic. Speculators rushed to buy gold in London. In just a few days in March, the pool had to dump enormous quantities of metal onto the market to keep the price from exploding. The United States resorted to flying gold across the Atlantic on military planes, airlifting bars from Fort Knox to London vaults so they could be sold the moment the fixing threatened to drift above the sacred number. Picture that clearly. You're watching planes loaded with gold bricks guarded like weapons, crossing oceans not to fund a war, not to support disaster relief, but to defend a price target. $35, not 34, not 40. A single politically chosen number. The more gold they sold, the clearer it became that the price on the board was not natural. It was an illusion, sustained at an enormous cost. Reserves were draining. Credibility was leaking. The market sensed blood. On March 14, 1968, the strain became impossible to hide. The United States quietly asked Britain to close the London gold market to stop the hemorrhage. The UK declared an emergency bank holiday. For 2 weeks, the world's most important gold market simply shut its doors. No fixing, no trading, no price. Behind closed doors in Washington, central bankers and finance ministers met to decide what to do next. The conclusion was unavoidable. The London gold pool, the secret cartel that had defended $35 for 7 years, was finished. It could not be saved without sacrificing far more gold than any government was willing to lose. The Pact was dissolved. When London reopened in April, gold traded in a world that looked the same on the surface, but the foundation had cracked. The first line of defense for the Bretton Woods order was gone. The authorities tried a new strategy. Instead of pretending the market and the official world were the same, they split them. They created what became known as a two-tier system. In the official tier, central banks would continue to value gold at $35 an ounce for transactions between each other. In the private tier, gold would trade freely at whatever price buyers and sellers agreed. On paper, it sounded clever. In reality, it was an admission. It admitted that the free market price was higher than 35. It admitted that the old peg was no longer defensible. It admitted that the story holding the system together was changing. From that point on, gold and the dollar were no longer truly wed. Central banks agreed not to buy gold from the private market. The United States promised not to sell gold into that market to influence the price. Everyone tried to pretend that the old official price still meant something, even as reality drifted away from it year by year. By 1971, the illusion was exhausted. Inflation in the United States was rising. Trade deficits grew. Foreign central banks, led by France and others, kept asking to convert their dollars into gold. The numbers no longer worked. There were far more claims than there was metal. In August of that year, President Richard Nixon went on television and announced that the United States would temporarily suspend the dollar SS convertibility into gold. Temporary became permanent. The last link between the U.S. currency and gold was severed. Bretton Woods died that night. The world entered a new era of floating currencies, ever-expanding credit, and a free gold price that would climb into the hundreds, then past $800 an ounce by the end of the decade. The London Gold Pool had been the first defensive wall. When it fell, the rest of the structure eventually followed. So what was the London Gold Pool, really? On the surface, a technical arrangement to stabilize a key commodity price. Underneath, it was a rare glimpse into how power behaves when the story holding the system together starts to unravel. It shows that so-called free markets are often managed. The gold price of the 1960s was not some pure reflection of supply and demand. It was the outcome of quiet phone calls, gentlemen's agreements, and coordinated interventions by a small group of central banks. When you see a perfectly flat line in an unstable world, you're often looking at fingerprints, not nature. It shows that fixed prices create pressure, not safety. By insisting that gold must be worth $35, the system invited speculators to attack that line. Every new dollar issued, every new deficit run, increased the tension. The more they tried to freeze reality, the more violent the break had to be in the end. It shows that international cooperation has limits. As long as the cost of defending the price was moderate, the pool held. But when losses mounted and political priorities diverged, when France prioritized its own reserves, when the UK had its own currency crisis, when the US refused to change course, national interest beat collective promises. The pact was only as strong as the weakest member's willingness to keep losing. Most of all, it shows that trust is the real currency. The pool didn't collapse in a single day because they literally ran out of gold. It collapsed because participants in markets stopped believing that 35 meant anything. Once faith in that number vanished, no stack of communiques and no closed-door meeting could put it back together. Underneath the battles between central banks and speculators, there was a deeper conflict, the conflict between illusion and reality. Reality said that gold, as a scarce asset, was worth more than the official price in a world drowning in paper promises. Illusion said that governments could legislate value, pick a number, and hold it there indefinitely through willpower and coordination. For a while, illusion won. For a while, planes full of gold and nights of emergency phone calls were enough, until they weren't. You might be tempted to file this story away as an interesting relic from the 1960s. But the pattern didn't retire with the London Gold Pool. Whenever you see authorities insist that a particular level is non-negotiable, a currency peg, a target interest rate, a strong commitment to this or that price, you should remember London in 1968. Whenever you see markets that seem strangely calm in the middle of turbulence, you should ask, who's in the room holding the line and what happens when they can't? Every era has its own version of the pool. Central banks band together to stabilize exchange rates. Governments coordinate to cap bond yields. Institutions create new tools and new acronyms to avoid saying the obvious. They are fighting the market to defend a story. The labels change, the structure doesn't. The London Gold Pool started as a promise. We will stand together to keep gold at 35. It ended with emergency market closures, drained vaults, the collapse of the very system it was built to protect. That's the rhythm you see again and again in financial history. First, they insist the price is under control. Then, they quietly form a pact to keep it there. Then, the pact becomes too expensive to maintain. And finally, the market reminds everyone what things are actually worth. So the next time you hear that a key price is anchored, contained, or under control, remember the gold flown across oceans to defend a number on a screen. Remember the secret pact that almost nobody knew about until it was already collapsing. Remember that somewhere, unseen, someone may be fighting a losing war against reality. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.